Meeting to order, and the first order of business is roll call, please.
Henry Jones.
Here.
Richard Costigan.
Here.
Margaret Brown. John Chung, represented by Steve Juarez. Rob Fechner. Good morning. Richard Gillihan. Here. Dina Hollinger.
Here.
Priya Mather.
Here.
David Miller.
Here.
Ramon Rubalcalva.
Here.
Bill Slayton.
Here.
Teresa Taylor.
Here.
Betty E.
Okay, thank you. The next item on the agenda is approval of the June 18 Investment Committee timed agenda. This is a new process that's being used for all committees to help us manage our time during the day and to try to stick to a predetermined time of how long we're going to be meeting and how much time we're going to take on each item. So if you've moved by Mr. Costigan, second by Ms. Hollinger, all those in favor say aye.
Aye.
Opposed? Hearing none, the item passes. Thank you. The next item is Executive Report, Chief Investment Officer Briefing, Mr. Liabilities.
Right. Good morning, Mr. Chair, members of the Investment Committee. We do have a very full and timed agenda for us in front of us today, including some time constraints for outside presenter who will be presenting on our private equity business model item a little later in the morning. So I'm very mindful of that time, and I'll keep my, my comments brief as a result. I did want to take a few minutes at the outside to frame our discussion on private equity business models up front. Just for some framing of the issue, I wanted to start by really reiterating something that we have discussed quite at length over the course of the last 3 years. Both the importance of private equity in our portfolio and the rising importance of private markets within the overall global capital marketplace. Seems like a long way back, but looking back at November of 2013, we spent a full day together with the Investment Committee in a workshop on private equity. I think many members of the committee remember. And we spent that day digging, very deeply into the components of private equity. And some of the highlights, I think, of that day are worth mentioning again as a frame of reference. Number one, private equity has the highest return profile in the total fund, both from a perspective of looking backwards at the actual results that we've achieved. It has achieved the highest rate of return in the portfolio, and prospectively looking forward, it is projected to earn the highest rate of return in our portfolio going forward. Two, in that workshop, we estimated that at the low end, our actual private equity portfolio added more than $11 billion of added value over and above what we otherwise would have been able to achieve in our public equity portfolio. And that's $11 billion that we didn't have to make up in either contributions or other sources of return. Three, private equity expands our investable universe dramatically beyond what's available in the public equity marketplace. Fourth, private equity represents really the most growth in capital markets over the last decade. It's grown to almost a $4 trillion marketplace today, and projections are for it to continue that growth into the future. And last in that workshop, we, the investment staff, really have concluded that there are no obvious public market substitutes for our private equity portfolio. So why is that all important, and why is that frame of reference important? Well, we're currently 71% funded status, and we have a return target going forward of 7%, which is a relatively high rate of return to achieve, especially thinking about this current period we're in of relatively low interest rates. In addition, over the next 10 years, we have, rather muted expected returns going forward. In fact, in our last asset allocation exercise, private equity is the only asset class in our asset allocation which is projected to deliver returns greater than 7% over the next 10 years. Therefore, during our most recent ALM exercise, we considered and we concluded that private equity was an important and essential part of our asset allocation. We set a target of 8% for private equity, really recognizing where we are today, which actually today we're at about 7.5% weighting to private equity, and the challenge of maintaining even an 8% level given the scale of CalPERS' overall portfolio of $350 billion. So in a world and marketplace where private companies are staying private much longer and growing to be much larger, and where public companies are choosing to go private. In fact, we've looked at the statistic as a committee together that the number of U.S. public companies is roughly half where they were 20 years ago. The opportunity is presenting itself to find effective ways for CalPERS to participate in that growth in the private markets at an appropriate scale for CalPERS. The good news is that the private market trend is providing CalPERS with this opportunity, the opportunity to invest at the scale we require to be meaningful. Now, we have confidence that the strategy we'll be proposing later in the agenda will allow CalPERS to responsibly invest at scale and allow us to reach a future target of 10% of the portfolio. It's important to underscore that this is not without risk. We've discussed the risks, and we'll be discussing the risks in more detail a little later this morning. But the alternative is staying put on our current course, which will lead to an allocation to private equity much more like 5% of the total portfolio. Now, we've done a back-of-the-envelope estimate of the impact of that difference between having a 5% allocation to private equity versus a 10% hoped-for allocation to private equity on a $350 billion portfolio that we project and hope to earn 7% over a long period of time. And the difference between having a 5% allocation and a 10% allocation over the next 20 years, assuming we earn the return projections in our asset allocation, is approximately $15 to $20 billion. And that $15 to $20 billion, if we don't earn in our private equity portfolio and we're not able to think of other components within our asset allocation, and to date we have not, then that means that $15 to $20 billion needs to be made up elsewhere, either through additional contributions from our employers or employees, or through new and different asset allocation techniques that we, to date, have not identified. Now, this is a window of opportunity for CalPERS, but you need to be comfortable as your staff is, that this strategy is the right path for CalPERS. The very long-term, multi-generational nature of private equity investments require a long-term commitment that we all own as an organization. And that's why I think it has been worthwhile for us to spend the last 3 years in the deliberations around private equity and the strategy that we'll be discussing in more detail later in this morning. So with that, Mr. Chair, I'm glad to finish my remarks and move on to the rest of the agenda or take any questions that might be.
Yes. I'm going to ask that if there are questions related to private equity, that they be held until we get to that item. But if there are any other questions you have of Mr. Liabilities, it's certainly can be entertained. So seeing no questions. Okay. Okay, the next item on the agenda is a consent action item for approval of the May 14,
Move approval.
moved by Mrs. Mathers, second by Mrs. Taylor. All those in favor say aye.
Aye.
Opposed? Seeing none, the item passes. I have not been asked to take anything off of the information consent item, so we will now move on to the next item, which is the action agenda item, real estate investment opportunity.
Actually, no. We're in the open session agenda item 6A, which is
6A.
the affiliate trust asset allocation.
Page was missing.
Yes.
6A.
And Eric Baggison and team are making their way up. I think he just gave Paul a little bit of a heart attack.
Yeah. It's on the back.
Okay, good morning. Eric Baggison, Managing Investment Director for Trust Level Portfolio Management. On this agenda item, 6A, continues in the line of agenda items that we've had for the last several months, basically going through the various affiliate funds and extrapolating the information that we developed during the ALM process for the PERF into those funds and moving the asset allocation forward. We've covered so far basically the various defined benefit programs, the defined contribution program, the savings program, and today we're going to be touching upon the healthcare fund reserve portfolio and the long-term care portfolio. Consistent with what we've done for the last couple of agenda items, Christine Reese, an investment manager within the Global Equity Program, is going to provide some background around the structure of those two funds. Although we have organized this information where we're going to cover the healthcare fund first and then loop back into the long-term care fund. So we're basically going to separate it into two sort of distinct little parts. One of the things I'd just like to take a moment to do and recognize, though, is that in order to move this asset allocation work forward for the affiliate funds, it actually requires a tremendous cooperation across many different parts of the organization, as well as with external entities. Slide number 3 in the attachment starts to list out some of the various teams that are involved in this. So you literally have dozens of people within CalPERS that are attached to the work product that you see in front of you, and the information that is developed basically for you to make a decision on in relation to that asset allocation. And that cooperation is not to be trivialized. There's many, many different points of view that are brought to the table in any of these agenda items. As I said, we're going to separate the healthcare reserve from the long-term care program, and I think without any further yakking at you, I'll turn it over to Christine.
Thank you, Eric. Christine Reese, CalPERS team member. So to start, let's see, oops. I think I'm missing one of my pages. Okay. Nope, there it is, sorry. Okay, so we're going to start with the characteristics for the healthcare fund reserve. And before I get started on the details, just want to basically describe that the healthcare fund reserve that we are reviewing today is the reserve for the self-funded plans for our healthcare program. And looking at slide 6 is a brief history of the healthcare fund. So in 1989, the self-funded healthcare plans were established, and at that time, reserves were held by the Treasurer's Office in the Surplus Money Investment Fund, which is a short-term investment fund. In 1997, the reserve fund was moved into CalPERS Investment Office for management, and at that time, a bond allocation was approved. That bond allocation remains in place today. In 2013, we moved the the bond allocation from an active management to a passive management. And in 2016, we reviewed the asset allocation, confirmed it, and although it's only been 2 years since that time, we are back again in order to sync up the timing of this asset allocation with the timing for the PERF. So on a go-forward basis, it will be reviewed every 4 years after the PERF has gone through its strategic asset allocation review. So moving on to the purpose of the Healthcare Fund Reserve, again, this is for the self-funded plans. There are 3 primary purposes, and they're meant to cover worst case scenarios in some cases. So for example, expenses that have been incurred but not yet paid in the event of a PPO shutdown, to cover claims that might exceed premiums, and to cover any sort of catastrophic or unforeseen event such as a pandemic. So with these purposes in mind, in terms of investment strategy, we would want to keep the reserve conservatively invested to keep it a shorter duration and highly liquid. The investment policy objectives, which are shown here, they've been designed to align with the purpose of the reserve, so really to focus on that stability of principal so that the reserve is there when it's needed, to generate some returns but within a highly prudent level of risk, and then to maintain the liquidity in order for those reserves to be called on short notice. And this is the last slide for my section for the healthcare fund. This shows the reserve investment performance over the last 10 or so years. The blue line is the performance of the reserve. The red line shows the benchmark performance. And you'll notice that in June of 2013, when we moved from active to passive, the performance is in much closer alignment with the benchmark, so we expect that to carry forward. And in general, the performance of this reserve is in alignment with the allocation that we've selected. So at this point, I'll turn it over to Allison, who will continue with the strategic allocation.
Good morning. Allison Lee, investment manager from CalPERS Trust Level Investment Portfolio Management Team. So the strategic asset allocation for the healthcare fund reserve is directly dictated by its investment objective, which are stability, liquidity, and modest return over cash. So staff recommend to maintain the current 100% allocation to U.S. fixed income. So based on the Borrow One risk model, the Bloomberg Barclays U.S. Aggregate Bond Index is forecast to maintain a relatively low level of volatility of 5%. Staff believes this level of volatility is suitable for the healthcare fund reserve because of its requirement for liquidity to pay for healthcare claims and the program's requirement to preserve capital. So here, staff did analysis about whether capital would be preserved in 3 scenarios of changes in interest rate over a 12-month period if the fund is invested in the Bloomberg Barclays U.S. Aggregate Bond Index Fund. So the 3 scenarios are, first, is a steepening of the yield curve with 100 basis points increase at the 30-year maturity. The second scenario is a twist of the yield curve with 1% increase at the 3-month maturity and 1% decrease at the 30-year maturity. The third scenario is a 1% parallel shift throughout all maturities. So the price impact on row 2 is estimated using the Bloomberg fixed income fundamental factor model. So the impact on the bond price are estimated to be an investment loss of 4.6% for scenario 1, 5.5% for scenario 2. It will also provide an investment gain of 3.9% for scenario 2. However, if you look at the impact over a 12-month period, the relatively stable income return portion on row 3 will alleviate the value reduction to 0.7% for scenario 1 to 1.2% for scenario 3, and will actually provide a value increase of 6.9% for scenario 2. So based on this scenario analysis, staff believes the current allocation is within tolerant for the healthcare fund reserve. So now we are ready to answer any questions on the healthcare fund reserve.
Yes, we do. Mrs. Mather.
Would you like a motion on this portion of the item now?
I would suggest we could hold the
Separately.
motion basically until all the material's been presented, if
All
that
right.
would work for you.
Thank you.
Okay, are there any further questions, Mr.
No.
Jones, on this one?
No.
Okay, I think we're going to turn it back to Christine to go into the long-term care.
Thank you, Eric. Okay, so the long-term care program, starting off with the program objective. So the objective of this program is to provide program members with financial protection for the high cost of care caused by chronic illness, injury, or old age. And the costs are associated for care provided for those who have difficulty managing the daily activities of life, or supervision for those who may have cognitive impairment. So much different cost than strictly medical costs. Again, page 15, a little bit of history on the program. So the program has been around for about 23 years, launched in 1995. In 2008, the program was closed to new applicants in order to go through a stabilization period in which many elements of the program were adjusted and modified, one of those being the asset allocation. And that asset allocation is the same asset allocation that we have in place today, so we've held it since 2012. We did reaffirm that asset allocation in 2015, and today's presentation, again, is to align it with the 4-year sequence with the PERF. Slide 16 shows some key statistics. These are as of June 30, 2017. Really just to show the size and scale of the program. So the program currently has 128,000 plus participants, of which 7,200 plus are currently in claim. Benefits on an annual basis are around $300 million, and in looking at fiscal year 2017 over 16, there was an 8% increase in those claim costs, or in terms of benefits paid. And then program size in total, we've paid out $2.2 billion in benefits since inception, and the asset value in the fund is $4.4 billion, and we are one of the larger programs in the nation. So in looking at the characteristics that will help us derive the strategic asset allocation, slide 17 shows the historical number of active enrollees and claimants. So if we look at the blue line, which is the top line, in 2007, there were approximately 170,000 participants, and that has declined to approximately 120,000. So we're taking in fewer premium dollars into the program. The lower line shows the claimants, and in 2007, there were about 3,500, and present time, actually 6/30/2017, there are about 7,300 claimants. So we're paying out higher claim dollars, we're taking in fewer premium dollars, which indicates that the fund has a lower ability to absorb any market volatility. Looking at slide 18, this shows the historical assets and liabilities along with the discount rate. So the discount rate is the green line that starts off higher on the left and reduces down to the right. And basically what this shows is that currently we're at a 5.25% discount rate, and over the last several years we've brought it down in alignment with expectations. The red line is the present value of future benefits less premiums, and then the blue line is the fund asset market value. So where I want to focus is on the current state, which those two elements are almost virtually equal. We're at a margin of negative 1.45% with the discount rate at 5.25. And what this again indicates that the fund has a lower ability to absorb market volatility. The last graph I'll cover is the historical and projected premiums versus claims. And so what this shows is for the population that is currently in the program, it shows expected premiums over time and expected claim payouts. And the important time period is in 2017, 2018, there's a point of inflection where the fund starts to, premiums versus claims starts to become cash flow negative. Again, an indicator that we would want to minimize market volatility within the fund. All right. So that is the conclusion of my part, and Allison will continue.
Thank you. So steps to obtain policy portfolio through strategic asset allocation process is similar to what we discussed last month for LERS, JERS 2, and SERP. It's also similar to PERF as we discussed last year during the asset liability management process. However, long-term care has its specific characteristics. For example, instead of contributions, the process actually estimates premiums that all current enrollees are required to pay. Again, capital market assumptions are the same as we discussed last month for LERS, JERS 2, and SERP. Also are the minimum constraints on inflation-sensitive assets, such as tips, commodities, and rates to enforce more diversification in the potential policy portfolios. One additional constraint that's unique to long-term care fund is the maximum 15% exposure to global equity. This constraint was established in 2012 after the long-term care market study and detailed analysis jointly conducted by Walsher Associates, United Health Actuarial Services, who are our consultant on the actuarial side, and the CalPERS Actuarial Office and the CalPERS Investment Office. The analysis still applies to the liability attributes of the long-term care fund, as we shall see in the next slide. So here, there are 4 characters that staff examined, which are all support the staff's recommendation to keep the existing level of volatility. First is the funded status. So when a fund is well-funded, it's predicted that it's able to satisfy its future liabilities at the existing level of expected mean return. Furthermore, the lower the existing level of volatility, the tighter would be the distribution of the final outcomes around this mean estimation. So for the long-term care fund, which is currently funded at 99%, also with the 15% maximum exposure to the risky assets global equity, it's prudent to keep the existing level of volatility. The second character is the duration of liabilities. This character is similar to that of the pension fund. When the claims liability are due in the further away future, the fund has time to ride out any market turbulence. However, as we see from the previous slides, the participants in the long-term care fund have aged. So the claim payments are due in the near future. So the fund needs liquidity and does not have time to wait for the market to come back if there's a market drawdown. And the third character, the cash outflow, is closely related to the previous one. As more and more claims payment becomes due, the fund sustains cash outflow. Thus, the fund needs liquidity and is not in a position to take more market risk. The fourth one, diversity of contributions, is unique to long-term care fund, which is its singular funding source. Members' premiums. Because risk cannot be shared among multiple funding sources, the risk tolerance of its single funding source is relatively low. So all the four characters we examined will support the staff recommendation to keep the existing level of volatility. So as you can see on the efficient frontier, the recommended policy portfolio is very similar to the current policy portfolio because they have the same level of volatility. There is a slight redistribution among fixed income commodities and rates because of change in capital market assumptions, but the gain in efficiency is not significant. So staff would recommend a gradual rebalancing to the new recommended policy portfolio, taking advantage of the routine cash flow and the market gyrations. So as you can see from this table, the expected returns from year 1 to 10 is based on the CMAs from the investment office. The expected return from year 11 to 60 are based on CMAs from the actuarial office, and the volatilities from year 1 to 60 are the same, agreed upon by the actuarial and the investment office. The blended return is based on the forecasted net cash flow of the long-term care fund. This is consistent with industry practice. So the blended return supports the discount rate of 5.25% that has been approved by the investment board in February 2018. The recommended asset class ranges are based on the practical knowledge accumulated in managing this fund and is consistent with the current implementation practice. It is believed that those ranges will reasonably reduce any frictional transaction cost on the backdrop of the routine cash flow and the market gyrations. So that's conclude my part of the presentation.
Okay, thank you very much. If you can go back to slide 17.
Yes.
And that the data shown here is through 2017, but it appears that there's a path that's occurring in the future that these will cross. And what are those projections of when that would occur, if that's a correct assumption?
Oh, they will not cross. I think there used to be a graph that actually showed them cross because actually the axes on both sides are at different scale. Mm-hmm.
Okay, I see. Okay, thank you. Mr. Slayton.
Thank you, Mr. Chair. If you can go to slide 19. And I just noticed that apparently, according to my own demographics, when I hit age 90, I'm probably not going to get much beyond that because of the steepness of the curve in the red line. My question is that because the pool of enrollees are essentially in my generation, so that group is going to pass and we don't have a large group coming beyond it. Is that the reason for that sharp decline?
Yes, this estimate is only based on the current enrollees. There's no projection about new enrollee joined the long-term care fund.
But we do have new enrollees coming in.
Right, but the practice of such projections is all based on whether we have enough fund to pay the current enrollees.
So our contribution rates that we have for new enrollees, as we've made adjustments over time, we're confident that those contributions can cover those liabilities, at least as currently projected. So they're not. Is that why they're not part of this calculation? Because it seems like it's just part of the universe that we're looking at here.
Why don't I take a shot at that one, Mr. Slayton, Eric Bagus, and CalPERS staff. What you have in this graph, just to be clear for everybody, is that middle block, the annual projections, are annual projections. That last right-hand block are 10-year projections. So you're literally seeing that steep drop-off in the line, basically, is because you're literally looking at things decade by decade. So
I see. Yeah, you're right. We're changing the scale.
Yeah, there's a change in the scale, which
I got worried, but now maybe I don't need to worry quite so much.
But I think in relation to your real question, though, about whether future contributions basically are adequate to cover the liabilities, it is believed that that is the case, but those future contributions are calculated across a whole array of assumptions. In other words, so there are assumptions about the proportion of beneficiaries that will go into claim status, the costs of the medical care that they'll receive, the duration of that care. All of those elements basically are all estimates, and all of those estimates are absolutely subject to being misestimated as well as being accurate. So one of the realities of this type of a program is that the actual premiums paid by the beneficiaries will adjust to reflect whatever reality is. And that's obviously been one of the elements that have impacted this program and virtually every long-term program out there, is that initially most of these programs, I think, underestimated the utilization and the costs of that utilization. So all of them have been adjusting their premium structures. So it is unclear whether or not the assumptions that we're currently operating with will ultimately result in the ability to do that, but the plan does have the ability to adjust itself, basically, given whatever reality we end up with.
Okay, very good. Thank you.
Okay. Mr. Costigan?
Thank you, Mr. Chair. Excellent report. The detailed, I know we didn't go through all the slides, but just a great report. Love the data. Just a couple questions. One is, you said we have 128,276 participants, but we're actually seeing a drop in the number of participants to about 120,000. Did I hear that correctly?
Yes. So let's see. Yeah, so the data on page 16 was from the September 2017 Health and Benefits Committee agenda item. The page 17 is from the actuarial valuation report, so there might be a slight timing difference there.
And I'm sorry, all website, I'm fine with the numbers. I was just trying to get, is the drop-off due to people dying off or no longer paying their premiums? Do we have data that shows which it is? Because actually the benefit structure is only about $40,000 per claimant, which is actually pretty good given the cost of long-term care in California. But what do we attribute the drop-off to?
By and large, it is due to death.
Okay. So we're not seeing that with the increase in premiums or with the program itself, what we're seeing is the drop-off is due to people aging out of the system, passing away in the system, and benefiting
Correct.
from it. Okay. And then I was looking at the chart going out to 2077, and is that just, why do we pick 2077? Is that, I mean, I know sometimes we talk about 75 years, lives and being, or is that just, we just projected it out that way, taking the first person in the system and assuming they're going to live 70 years? So taking someone, I'm just trying to get at why 2077? Did you take an 18-year-old, add 70 years, and say that's when they're going to, because I'm like Mr. Slayton, I've actually planned on passing considerably sooner to any of this. At least that's what my financial plan says. But
yeah, in terms of the methodology, in terms of the projection, that's part and parcel of the actuarial valuation report. So we're showing that data, and in terms of the methodology going out to that year, we'd probably need to check back in with them.
Right, because that was just as Mr. Slayton raised. I mean, it's 70 years worth of data, 59 years from today, and we're projecting a drop off in 2047. So you're just trying to look at the class of folks, who's in there and what caused it to drop off. But the claims, I mean, you would certainly hope you would see as each year goes out that number not have the drop off, because you'd have more people coming into the system. I mean, it just kind of refreshes itself going forward. So I know there's a drop off, but the assumption is this significant drop-off is the population of today.
Exactly.
Okay,
Yep.
Thank you.
Ms. Mather?
Thank you. Yeah, I want to commend you on a really thoughtfully prepared agenda item. I thought this was really excellent work and gives this committee a strong basis for making a decision on both of these funds, the asset allocation. So with that, I will move the staff's recommendation regarding the asset allocations for both the health care fund and the long-term care fund.
It's been moved by Ms. Mather, and the second was Mr. Slayton? Okay. Okay, so all those in favor say aye. Aye. Opposed? Hearing none, the item passes. Thank you very much for the report. We will now move to revision of the total fund policy, second reading, item 7A.
Great. Mr. Chair, I am going to turn this over to Elizabeth Borky, our Chief Operating Investment Officer. She joins us from Zurich, Switzerland, and she's been here in Sacramento on the job now for 1 month. And I'm giving a little bit time for Kit and team to get up here. And with the assemblage, I am very happy to hand this item over to Elizabeth.
Look like we're going. Why don't you check that with me?
Press that button.
Good. Thank you and good morning. Elizabeth Borky, CalPERS Chief Operating Investment Officer. There are 2 investment policy items on today's agenda. Item 7A is a second reading of staff proposed changes to the total fund policy arising out of this year's annual review. The annual review is part of our routine review process and serves primarily as an opportunity to make necessary updates in order to reflect board direction and organizational changes. Following feedback from this committee at the May 14, 2018 first reading of the policy, staff has returned with a revised version of the policy for consideration by the committee. Kit Crocker, our Investment Director for Investment Compliance and Operational Risk, will provide an overview of the proposed changes since the first reading.
Thank you, and good morning. Kit Crocker, CalPERS staff. As this is a second reading, I will focus my prepared remarks for this item on just the changes made in response to the feedback from this committee last May, and also on the updates, importantly, that were required to reflect the board's approval in May of the new asset allocation targets and policy benchmarks. The new changes are described as such in the agenda item and indicated with yellow highlighting within the enclosed markup of the total fund policy. I should also note that if and when we receive final approval for the proposed private equity business model alternatives, staff will come back to the committee with any indicated updates to the total fund policy. Moving to the changes, the most material of these new changes are the revisions to appendices 4, 5, and 6 to reflect the outcome of the recent ALM process, namely the updating of the asset allocation targets and policy benchmarks, and also the revisions to Appendix 2 to the policy to require prudent person opinions, or PPOs, for certain transaction types within private equity. The proposal is to require PPOs for all co-investments and customized investment accounts in an effort to improve consistency between our private asset classes. Finally, to say a word about the investment beliefs. While staff thinks it appropriate that the policy reflect the board's lead role and ownership in terms of the beliefs, we also recognize, of course, the important role staff plays in the process. And if there is any desire to strengthen the language around staff's role, we would propose to revise the applicable sentence, which appears at page 36 of page 104, to read that staff will facilitate this process as requested by the committee. We will look for the committee's direction in that regard. As this is a second reading, we are seeking action by the committee at this time. And with that, I'll pause for any questions and also ask and invite PCA, Makita, and Wilshire to comment. Thank
Okay,
you.
before we get to questions, I want to ask the consultants to make their comments.
Andrew Junkin with Wilshire. I think Kit just hit on the one issue that we really wanted to draw out for some discussion, which was about the investment beliefs and how that process will look the next time around. We do believe that the committee really is the owner, that is the investment committee's job is to set the investment beliefs, that staff should obviously facilitate it. I think the proposed language change makes sense. And it is collaborative, I understand that, but really this is this committee of 13 saying this is what we believe and giving instructions for all sorts of stakeholders, consultants, staff, outsiders, about how you're planning to invest in the very long run for the PERF.
Thank you.
Steve Hart with Makita Investment Group. I think Kit pointed out the key thing that we have in our letter as well, talking about the PPOs being required for all the transaction types except for funds, and that is outlined in there. Also recognizing that as there continues to be change, should there be change in the private equity program, that certain portions of the policy will need to be revised to reflect that.
Okay, PCA.
There weren't any terribly material changes to the real estate portion of the policy between the first and the second reading, but I'm happy to answer any questions.
Okay, thank you. Ms. Taylor.
Yes, thank you. I wanted to thank you for the report. It was great work, and thank you for your first report. So I appreciate it. I had a couple of questions. I had seen something that we announced, the great work we're doing with other large investors, where we're managing our risks and exploring other market opportunities on climate, gender equality, and infrastructure. So I was wondering if we wanted, and I don't know this, if there are any policy changes that we needed to include to reflect this work that we're now doing that we announced earlier this month, or is it already covered here? I mean, I read it, but I didn't think I saw it, so Ted?
Sure, yeah, I'll jump in. It's referring to the invitation we received from the G7.
Right, then the work we're doing with them
in Canada. I don't believe we need any total fund policy changes. We believe we have the policies in place that reflect our investment beliefs and those areas of priority actually within our sustainability 5-year plan, as well as the delegated authority for staff to work on those areas. So I think we're covered.
Great, great. And I know that I had initially thought somebody was going, so then when I was advised that it's a work team, I was pretty impressed that we'd even been asked. And then I had a last question. I just read, and I can't remember which publication I read it in, that Warren Buffett, Jamie Dimon basically are talking about getting rid of quarterly reporting. And I'm wondering what's your opinion on that, and if you agree that that we should, work on changing this, like apparently they seem to be doing in the market. Should it be reflected in any of our policies here? I don't know, does it, because we do the quarterly reporting anyway. I just thought it was interesting that these two big corporate, heads have decided maybe that they should be looking at long-term risk rather than this short-term quarterly reporting risk. So
it's a very interesting topic, and one that we're collectively very interested in as long-term investors, and we've often discussed the dangers and of a preoccupation at looking at quarterly results. So we, applaud all efforts to look at ways to focus companies and share owners on longer-term investing. Again, I don't think the policy is the spot to put in place any language today, but within our governance and sustainability strategic plan, there's definitely a section on long-term sustainability, and that would be a good topic for us to come back to again and again, but in the near term to discuss approaches that might be taken, and at some point in the future, perhaps there is a policy change that could be recommended, but we're not prepared for that today.
Okay, great, thank you.
Thank you. Mrs. Mather.
Thank you. So my first comment is with respect to the investment beliefs language on page 36. I'm wondering if that last sentence should read something more like staff will consult with the board chair to facilitate this process. So something more affirmative, because I think leaving it up to the board chair to remember that every 4 years we need to review I think it's appropriate within the staff work plan to just consult with the board chair about reviewing. So I would suggest some language along those lines.
Yeah, that sounds good.
Not the board chair, I'm sorry, the committee chair.
Yes, understood.
I meant the investment committee
understood.
chair. And then on page 76, which I know is the governance and sustainability principles, which I know we've reviewed already, in light of the most recent or a recent Supreme Court decision around forced arbitration and basically allowing companies to require arbitration of with individuals and sort of prohibiting prohibiting litigation and or prohibiting collective action by employees. I'm wondering if, I'm sorry, I'm just getting myself to page 76, so just bear with me one second. Under the corporate culture language that we added, it talks about, so this is D3 on page 76, disclosure. Companies should ensure all settlements are reported to the board, and financial reporting standards generally require disclosure of material settlements. And I'm not suggesting a change right now, but I would like us to think about whether in aggregate, sort of an aggregate disclosure of settlements if they reach a material level, because the data shows—
Ms. Mather, 76 of the iPad, or?
I'm sorry, of the document, okay, which is page 261 of the iPad.
Okay, thank you.
So it's attachment 2, page 76 of 104. Okay. I would just suggest that we review that language again. Again, not suggesting that we make any changes today, but think about aggregating, because the evidence is that if people are arbitrating, the settlements are going to be lower, and it's not necessarily because there's less merit, but because of their ability to achieve an appropriate settlement.
So that would certainly be appropriate direction for us, and I know our sustainability team can take up that topic in future agenda items.
So directed.
Okay. Thank you. Appreciate that.
Okay. Ms. Yee?
Thank you, Mr. Chairman. I appreciated the suggestion by Makita to perhaps review the real assets policy with regard to the use of independent opinions, and also perhaps extending it to certain private equity investments of a material size. And I was just wondering what the staff response to that might be in terms of the appropriateness and the feasibility of doing so.
I'm sorry, Madam Controller, in terms of
the appropriateness and the feasibility of doing so.
Of doing, I didn't hear, of doing
of the use of independent opinions in the real assets.
Oh, in the real assets, that's the part I didn't hear. Thank you so much. I do think it's always appropriate to look through our practices. I think this conclusion, or the conclusion of this review that we just did with the consultants and staff, in this case PCA and our real assets team, led us to believe we're comfortable with the level of and amounts therein. It's a fairly conservative and aggressive use of PPO opinions within that area. The risk categorization of our real estate strategy as core commercial real estate, which is on the lower end of the risk spectrum of all the potential types of real estate strategies. So that all leads us to believe we have an appropriate level today, and if anything, we would probably discuss with the committee and the real estate consultant as we look forward whether it's perhaps overly tight would be a consideration for the future. So I think that's the conclusion for today.
Okay.
And I think it's always good for us as a committee and staff and consultant to be thinking through it. But I completely concur that there's no need, why fix something that's not broken?
Right.
And the process, both the application of the process, the choreography of the process is working well within real estate.
Okay. All right. And then we'll consider the appropriateness when we talk about the private equity class separately. Okay.
Exactly.
Thank you.
Mr. Junkin?
I'm going to apologize. My mother was a grammar teacher, and as Ms. Mather drew my attention to D3 on page 76, I think the wording might need to change in that last sentence. If this weren't an action item, I wouldn't be bringing it up, but since you're about to vote, I think right now it says CalPERS supports settlements, and I think what CalPERS supports is disclosure.
Okay.
So I think it should read, CalPERS supports disclosure of settlements, including sexual harassment involving an executive or member of the board.
Okay. I think that's
I apologize for being nitpicky, but...
And that change will be made, Mr. Eliopoulos, when we take action on this.
Yes, we agree completely.
Okay. Before we vote on this item 7A, we do have a request to speak from Mr. Silberstein? Stein?
Thank you very much. My name is Steve Silberstein. Although I am a trustee of a county pension fund here in California, I am speaking for myself just personally here. I'm very interested, as some of you know, in the guidelines for voting on the CEO pay in these corporations that we're invested in, particularly the S&P 500 corporations, where the pay goes up year after year. The guidelines that we have are quite good here, and I commend the staff and the board for them. The problem is that the actual proxy voting on the pay packages, I don't think, has followed the guidelines properly. There are other pension funds who do a better job in speaking out against some of the excesses in CEO pay. One of our guidelines is that the salary should be no more than $1 million. And that's what it says in the guidelines. So I would assume that in the proxy voting, anytime there is a salary of more than $1 million, we would be voting against it. Of course, the total pay is usually about $15 to $18 million, which is all bonuses. So this doesn't affect the fact that the pay is higher than $1 million. On the bonuses, it says that our guidelines say that they should be considered in the context of the entire corporation and the entire compensation structure within the corporation. So as we now know, the corporations are disclosing the pay ratio between the CEO and the median worker, and there's quite a bit of variation. The average is about 300 to 400 times the average worker for the CEO, but there are quite a few big corporations where the ratio is more than 1,000. So I hope that when the ratio gets out of whack that would generate a negative vote. And the last thing I would like to point out is stock buybacks. A lot of corporations are spending a lot of their money on stock buybacks. Of course, when you buy back the stock, then the earnings per share go up because there's less shares. So if the CEO his bonus is computed on a growth in the earnings per share, but yet the corporation is buying back its stock, there's actually no change in the real earnings. It's all financial engineering using corporate cash. So when the bonus is calculated on earnings per share, but the corporation is increasing that just by buying back the stock, I think that should generate a negative vote. And then finally, a lot of studies now show that when these corporations are buying back their stock, the CEOs are selling their stock at the same time, and that also should generate a negative vote. Thank you.
Okay, thank you. Thank you for your comments. This is an action item, Mrs. Mather.
Oh, I'm sorry, I didn't realize I don't think I pressed it, but I'm happy to move the item.
Okay, moved by Mrs. Mather, second by Mrs. Taylor. Ms. Taylor. Okay, thank you. All those in favor say aye.
Aye.
Opposed? Hearing none, the item passes. Thank you very much for the report. We now will move to information item 8, policy delegation and delegation revision of private equity program policy, first reading.
Thank you. Elizabeth Borky, CalPERS Chief Operating Investment Officer. Turning now to our next policy item. Item 8A is a first reading of staff's proposed update to the private equity investment policy. This is an information item only at this point. Staff will be returning to this committee in August for a second reading, incorporating the feedback received today. With that, I'll turn the item over to Kit Crocker and Sarah Kaur from the Investment Office, who will review the proposed changes. Thank you.
Thank you. Kit Crocker again, CalPERS staff, and I'm joined now by the interim ID for the private equity program, Sarah Kaur. The proposed changes to the private equity policy are largely intended to streamline and simplify several aspects of the policy. With one or two exceptions, overall, the combined effect of these changes represents, if anything, a slight contraction rather than an expansion of staff's authority. I would also like to take this opportunity to clarify that if and when we receive final approval for the proposed business model alternatives, staff will, of course, return to this committee with corresponding policy updates for consideration. Moving on to the changes, one significant change is the way in which the staff authority limits are expressed to convert to the currently percentage-based limits to limits expressed in absolute dollar terms. This brings staff's expression of its authority limits in line with the way in which the real assets authority is expressed, and also, importantly, eliminates the moving target aspect of the old percentage of target approach. We're also proposing updates to the permissible transaction types and staff limits to bring them more in line with the current business model. And in at least one instance, we're proposing a change simply to eliminate a potential ambiguity and achieve greater overall simplification of the policy constraints. To address some of the more substantive changes then, first we propose the elimination of direct investments as a transaction type. And I should note in this regard that there's no connection with the CalPERS Direct. Rather, direct investments are a legacy structure that permitted CalPERS to invest directly in select GPs. The last time, however, that CalPERS made such a direct investment in a GP was in 2007. Second, as a result of the move to a single authority limit for first and second quartile commingled funds, the proposed new limit represents a significant lowering of staff's per commitment authority for top quartile fund investments, while increasing that authority slightly for second quartile funds. Third, we are proposing to add a cumulative fiscal year limit for MID commitments, similar to the one in real assets. Fourth, there's the elimination of the CIO's unilateral ability to increase committed capital to existing top quartile customized investment accounts. And finally, we propose an adjustment of the targets and ranges for the buyouts and credit-related strategies to reflect the transition of the credit-related strategies to the opportunistic team. In the pure cleanup category, we're suggesting a handful of changes to improve clarity and remove duplicative content. Today's item is a first reading, so we're looking for this committee's feedback. And with that, I'll pause for any questions and also seek comment by Makita.
Okay, we have a couple of questions. Mr. Juarez?
Yeah, it's clear to me by the write-up what the advantages and benefits are to staff. What are the advantages and benefits from these changes to the board? from your perspective?
I think that it's easier on both sides, frankly, to assess what the limits are and how they're applied. You know, one problem, for example, with the percentage of target expression of staff's authority was that it could look in hindsight like staff had exceeded its authority. Because assume if the fund were to temporarily fluctuate downward. So it is across the board, we think, better both for the oversight function and then for staff in trying to make sure we stay in line with the dictates from this committee, that we simplify and clarify where possible.
And then specifically to, you made mention of the fact that we're lowering certain limits for the CIO in given areas and then raising them in secondary investments, you said. Just can you give me a little bit more elaboration on the purpose for that?
Yes, I mean, as part of the simplification, we thought it didn't really make sense to distinguish for staff's authority limits between first and second quartile funds. And the change for first quartile is currently the MID has $1.7 billion. Assuming a certain fund, you know, the certain level of funding at the fund, that's being reduced significantly to just $500 million. So that comes down significantly. The CIO limit we're proposing now in absolute dollars is $1 billion. It would currently, doing the math, be over $3 billion. And so that's a significant reduction compared to then the second tier funds would be currently at $330 million for the MID and $660 million for the CIO, as opposed to $500 and $1 billion.
Okay. And just to close, so from your perspective, by lowering those limits, what does the system get out of that? I mean, is it more scrutiny, less discretion on behalf of the investment office? Maybe and appropriately so, I assume, or you wouldn't be recommending it? Is that what we're getting out of those changes?
Maybe I should let Sarah respond to that.
Sarah Core, investment staff. The decrease in the limits for the first quartile funds is mostly limited to or dictated by the allocations that staff can get anyway. So getting an allocation of over $1 billion to a commingled fund is highly unlikely, and that was why we put the $1 billion cap in there.
Okay. Ms. Yee?
Thank you, Mr. Chairman. I guess to follow on to Mr. Juarez's question, so will you still be reporting out private equity managers by quartile?
Yes, in the write-ups that staff produces for each new investment, it would say what quartile it is in.
Okay, all right. And then, so the limitations that are in place for funds that rank below the top, so the investment committee will still be required to approve those investments that are third level and below?
Anything below second quartile would require a prudent person opinion, okay. Which was discussed in the total fund policy item previously.
So that would, okay,
correct.
Good. And so I was curious about the emerging manager change. Does this allow you more flexibility to invest more than originally planned in the emerging manager program under the revised limit?
It allows for more dollars to be deployed per manager. So the limit previously would have been 330 for the MID and 660 for the CIO. It's now being increased to 500 and $1 billion.
Okay, so hopefully more. All right, good. And then with respect to co-investment, would all of the co-investment opportunities require a PPO?
Yes, they would.
Okay, good. All right, thank you.
Okay, thank you. Seeing no further questions, this is a first reading information item, so thank you for the report. And now we will move on to the next item on 9A, CalPERS for California and California Initiative.
Hey, Clint. Mr. Chair, members of the committee, I'm just giving time for the team to get up here. Clint Stevenson will be investment director on our team, will be leading this, as well as having Sarah Core from the private equity fund here as well. So Clint?
No, this is Clint.
All right, sorry. So the CalPERS for California report is a look at, Clint Stevenson, Investment Director. The CalPERS for California report is a look at the market value of CalPERS investments in California. At the end of June 2017, we had just over 9% of the CalPERS fund was invested in California. The report also looks at the ancillary benefits of CalPERS investments, including supporting local communities, local businesses, and workers. We have a report on the private equity class investments in the California initiative. That initiative supported over 266,000 jobs in California. This will be the last report of the California initiative. Many of those investments have been realized and the company sold. And as the investment committee may recall, at the December 2013 private equity program review, Rial DeRoche, Sarah's predecessor, explained that we were closing out the California initiative and looking at other ways we might achieve attractive returns and also support underserved communities. So Rial identified clean technology, mezzanine debt, and co-investments. And so 5 years later, what have we done? Clean technology, staff didn't identify any investments in the portfolio that warranted follow-on capital. Mezzanine debt, staff did invest $80 million in California-focused mezzanine funds. However, this isn't a scalable strategy, so we won't pursue that going forward. In co-investments, this is a scalable strategy, and will be looked at as part of Pillar 2 of the private equity business model. John Cole will touch on Pillar 2 in the next agenda item 9B when he updates the committee on the private business model alternatives. But I should remind the committee that we'll continue to report on private equity investments in California, just as we will report on investments in California and other asset classes. And with that, I'd like to hand the discussion over to Tom Woelfel of Pacific Community Ventures, PCV. PCV prepared both the CalPERS for California report and the California Initiative reports in tab 9A. Tom is the director of PCV's global research and consulting practice in impact investing. In this role, Tom leads and manages PCV's impact evaluation consulting services. Tom?
Next question. You mind handing that? Yeah. Hello, good to be with you all, and thanks for the introduction, Clint. So today I'm going to walk through findings from the 2017 CalPERS for California report, as well as the 2017 California Initiative report, which Clint mentioned will be the last examination of the ancillary benefits of the California Initiative. And so both of these reports are really intended to support CalPERS' efforts to engage with stakeholders across California and nationally. And the intention is to not only document CalPERS' investment presence in the state of California, but also the resulting ancillary benefits of those investments. So looking at the 2017 CalPERS for California report, this is the 8th consecutive year that this report has been published. And it documents CalPERS' investment presence in the state, including exposure to companies, properties, and projects statewide. And like all of CalPERS' investments, CalPERS' in-state investments seek to achieve appropriate risk-adjusted financial returns. So the top line figure in this year's report is that as of June 30th, 2017, or fiscal year end, CalPERS had invested $30.1 billion across the state. That represents 9.3% of the total fund as a whole. In addition to looking at the investment exposure in state, the CalPERS for California report also documents the underlying ancillary benefits that are generated through these in-state investments, including things like support of local job creation for California communities and residents. And so in looking at CalPERS' private markets asset class investments in real estate, private equity, and infrastructure, over 266,000 jobs have been supported statewide. This is a new chart within the CalPERS for California report that documents CalPERS' total capital as a whole, as well as capital in California since the report was first prepared in 2010. So you can see that over the last 8 years, there's been a rise in the amount of assets that CalPERS has as a whole, as well as the amount of capital invested in California. And the horizontal line shows the percentage of capital that's been invested in the state. And 2017 represents the high mark in terms of preparing this report at 9.3% of CalPERS assets in state. Since the report was begun, CalPERS has had at least 8% of capital invested in California. In addition to looking at the amount of capital invested in the state, we also identified the individual locations of CalPERS investments across the state to understand which types of communities are benefiting from CalPERS capital. But what this map shows is the location of each of CalPERS investments with the different colored dots representing the various asset classes in which CalPERS invests and the different size dots depicting different sizes of investment amounts. And as you can see, unsurprisingly, the majority of investments are concentrated in the Bay Area and greater Los Angeles areas, the areas of the state with the largest regional economies. Now moving to private equity's California Initiative. The California Initiative was established in 2001 and had two capital commitments with Phase 1 and Phase 2, known as the Golden State Investment Fund, that was managed by Hamilton Lane. And in that time, over $1 billion has been invested among 569 companies within the California Initiative. And the California Initiative was created to generate appropriate risk-adjusted financial returns that meet or exceed industry benchmarks through investing in traditionally underserved areas of California where investment opportunities may have been bypassed. So in order to generate ancillary benefits, California Initiative targeted investments in portfolio companies that had limited access to institutional equity capital, employed workers living in economic disadvantaged areas of the state, and also companies that had provided employment opportunities to women, minority entrepreneurs, and managers. And as Clint mentioned, this is the last year of reporting, and so there's currently a few remaining active investments within the California Initiative, and we would expect limited data should we collect additional data moving forward on those investments. So by and large, for the past 13 years in which we've been collecting data on the California Initiative, we've captured sufficient data on the ancillary benefits. And so this report represents the final examination of those ancillary benefits and combines that 13 years worth of data to really look at since inception results. So this year's report is a little different than past year's reports, which had focused on more of an annual look. So this provides kind of a full look back across the California Initiative over those 13 years that data has been collected. And so in summarizing those since inception results for the California Initiative, they fall across four primary ancillary benefit areas. First, focused on job creation and promoting economic opportunity. Next, focusing on areas that had been traditionally underserved by institutional equity capital, supporting workers in economically disadvantaged areas, and then providing employment opportunities to women, minority entrepreneurs, and managers. So in terms of job creation, the California Initiative has supported 176,000 workers statewide. In addition, those jobs that have been created in the time of the California Initiative have also tended to be higher quality jobs with health benefits and retirement levels outpacing both state and national averages. In terms of capital deployment to underserved areas of the state, the first capital commitment of Phase 1, approximately 16% of capital was invested in companies located in those underserved communities. And then for Phase 2, the Golden State Investment Fund, 46% of capital had been invested in underserved areas of California. And then also in terms of supporting low to moderate income workers or workers from those types of underserved communities, the California Initiative employed approximately 49% of workers from those types of communities. And lastly, looking at opportunities for women and minority entrepreneurs and managers, we saw representation of women and minority entrepreneurs and managers in leadership and management positions at levels that outpaced national benchmarks. So as a whole, the California Initiative has delivered significant ancillary benefits across the state of California, with Phase 2 or the Golden State Investment Fund driving a lot of those results, given a larger number of companies had been invested through Phase 2. And so with that, this concludes my presentation. I'm happy to take any questions on both the CalPERS for California report and California Initiative report, and welcome your feedback. Thank you.
Yeah, thank you. Yeah, I have a question, and I think I may have heard the answer, but when I read the report, it says the final report of final program year, and I'm suggesting to myself, why are we having a finalization in this program when we look at the jobs that are created, 176,000, as you said, you look at the risk-adjusted returns that you mentioned, you look at the underserved people that are employed, women and minorities. So why would we be canceling this program? But I want to be sure I heard you correct, that this program, the tenets of this program will be embodied in our private equity, one of the pillars going forward. Did I hear that correctly?
Yes. Let me address both of those clearly. Number one, we have tried to move away from separate small programs within all of our asset classes, but including in private equity. And I think the approach that Real signaled in 2013 to this committee was to reposition this effort, as your comments are underscoring, Mr. Jones, reposition this effort into the more mainstream of the overall portfolio rather than having a separate smaller scale program. So that repositioning was attempted, as Mr. Stevenson worked through. Now going into the future, there are really two pillars of the 4-pillar strategy that we'll get to later in the morning, perhaps even next. One is the Emerging Manager Program, where that program, one of its main ancillary benefits, is the diversity of managers that we find within the Emerging Manager Program. That is an area that we're in the midst of our search, and is an area our staff will explore this very topic of whether or not the quite substantial increase the number of diverse managers, women and minority managers within that program, also leads to investment opportunities in underserved areas or not. But that is the investment thesis, and we'll be exploring that as we select a fund-to-fund manager for that area. In addition, in Pillar 2, where one of the main goals of that part of the strategy, the Pillar 2 part of the strategy, is for a much larger and substantial co-investment program. And yes, one of the aspects of that will be to explore and ultimately conclude with an investment program and thesis around co-investments that would include the consideration of co-investments in companies, not only in areas that are well represented within private equity's traditional space, but also underserved. So it's a little longer answer to your question, but I want to make sure take time to take us through the history of it. But those are the two areas that would be covered going forward.
Okay, thank you. Mr. Juarez.
Yes, thank you for the presentation. Excellent. But I was caught by at least one of your graphs, which is, I think, a 3 of 6, showing the map. And I know in the Treasurer's office, we try to reach out to areas that are traditionally underserved by state investment and try to make sure that the double-barreled benefit that you mentioned here extends to those in what we would call the hinterlands, which includes Alta California, the Central Valley, the Inland Empire. And so my question is sort of twofold. One is that have we heard any pushback, or are they even aware of these regions, or even aware of their representatives, that there may be opportunities for investment that they could bring to your attention? And do we have any specific outreach that we do in geographic areas that are traditionally underserved that would help sort of create a picture with a little bit more distribution outside of LA and San Diego and Southern California, or San Francisco?
Yeah, that's a great question. I think I'll defer it to staff. But the one thing that I would mention in terms of a new development that I think has significant benefits potentially for California's underserved communities is in federal tax reform. The Investing in Opportunity Act had been included in this tax reform. And so recently, the governors of all 50 states have submitted census tracts identified as opportunity zones. And these opportunity zones enable investors to deploy money, their capital gains-free money, into these census tracts. And so the belief is that by essentially getting a very large tax break, there could be new investment opportunities that are generated within these opportunity zones. So I think, that's a development certainly to keep an eye on in terms of potential benefits for California's underserved communities.
I think that's right. Only I would just comment because I'm a little familiar with the Opportunity Zone. Most of those are outside of the traditional areas that have received like enterprise funds and the like. So you actually will be able to tap into communities that heretofore have not received the benefit of public funding. So I appreciate that comment.
The only thing I'd add, Clint Stevenson, the only thing I'd add is that the vast majority of the value of CalPERS private equity investments are in high minority areas, and that's outstanding.
And then the last, just to finish off, yeah, our managers, I think, are always out looking for portfolio company investments in every part of the state and the globe. They're motivated to find investment opportunities. In addition to that, this focus that we've had and the focus we'll have going forward really underscores our interest in making sure our managers are doing just that. On the outreach piece, part of this CalPERS for California report, our legislative affairs team uses this report, quite extensively at the legislature. We really, they do a really good job of briefing legislators in many of these communities that we're interested in investment all over the state, and do a good job of getting the word out in that form as well. We just wanted to add that as another component.
Yeah, just as an aside, it may turn it completely on its head if this three-state California proposal were to move forward as to what constitutes where you consider to be California versus outside of California.
With that, Ms. Yee.
Thank you, Mr. Chairman. Really appreciate the report, and I'm actually really sorry this is going to be the last of them. It's been tremendous success in the program, and I appreciate that this has been before the legislature with our orientation to members, but we consistently get requests from legislators, as Mr. Wire has suggested, particularly in even greater underserved areas. And so I was wondering if out of this report, is there a way to talk about some, I guess, sustained or lasting impacts, as we kind of transition out of our involvement in the program itself, that could then be the genesis of some additional thinking by the legislature or outside parties?
Just to reemphasize, to make sure, we will continue this CalPERS for California report annually. Yeah. And I think looking at an opportunity in that report to emphasize our both past and hopefully long-lasting impact in the underserved areas is an area we can take back and look at how we report that going forward. Okay. Or even,
I don't know if there is a way to even assess some models that might work in different parts of the state. There's just an unending appetite, as you know, up the street with respect to wanting capital to be deployed in different parts of the state, and unfortunately a shortage of it. But we've done such great work here. We've been able to make some sizable investments. Obviously the impacts have been great, but just not to kind of lose kind of the thrust of what's begun here. Okay, thank you.
Ms. Taylor?
Yes, thank you. I also wanted to thank you for the report, and I'm going to miss the report. However, I agree with my co-board members here. I think about as we work through private equity on emerging managers, I'm just wondering how are we going to break out that report so that we are, reporting directly on infrastructure being invested in or underserved populations here in California. Are we going to be able to do that?
The key is, as Sarah was reminding me as we were preparing this information, the key is if we want reporting from an external manager, we have to ask for that ahead of time. So certainly in our emerging manager and co-investment program, we'll do that. It gets a little more difficult when we look at the broad spectrum of all of our general partners, as it's not a standardized request. So sort of directly answer your question, within the emerging manager program. No, an emerging manager program, it's a yes. Our co-investment program and separate account program and direct vehicle program is a yes. In our more generalized commingled fund arrangement, that's not something we ask for, so that's a no on that front.
Okay. I just want to make sure that we are highlighting some of these investments and that we, as everyone has said here, we continue to be investing in California. So thank you.
Yeah, thank you. You know, also, I think it's important that the numbers that you cite, the 266,000 jobs and 176,000 jobs and the economic benefit, I think it's important that we remind the public that this is in addition to the $21 billion that we pay out to our retirees that create a significant economic benefit to the state of California, including jobs and et cetera. And so we just need to make sure the public is aware that this is in addition to all that economic benefit that's going on. So, okay, Mr. Miller.
Yeah, we'll probably be talking a little bit more about how we integrate as we look at our new PE models. Something like this, where we've got a very powerful program, we've got fantastic staff that are doing a great job with this kind of work, and that we don't foreclose opportunities in terms of long-term capability and capacity to do this kind of thing, not strictly through the third parties who we're going to be partnering with, but I think there's potential to keep this kind of work going, or at least not foreclose those opportunities. And so, just as I've questioned before, how do we do our long-term workforce planning? How do we do our really strategic workforce planning and integrate that into these new approaches and new models to make sure that we have the flexibility, that we don't foreclose those opportunities, and that we don't kind of walk away from very successful approaches that we've already got in hand. So just something I'm sure we'll be able to talk about more as we talk more about our PE models and other approaches.
Yes, we absolutely will have opportunity to talk about that in that context and going forward. And one of the things we'll be underscoring is, you know, these are domains of risk, and our experience on the performance side of these programs. In phase 1 of the program, I believe we had 9 external managers. 10. And out of the 10, you know, 9 underperformed, you know, quite significantly from a return standpoint. 1 manager performed quite exceptionally, and actually that exceptional performance, including the selection of 1 particular portfolio company, is what brought the overall performance of phase 1 from a negative 5% to a positive return, but still underperformed our benchmark, even with that significant approach. Phase 2, through a fund-to-fund manager, selecting different external managers has improved. It improved, as you saw in the ancillary statistics, in terms of penetration into underserved markets, and the performance improved into the second quartile, but still underperformed our overall benchmark. So part of the overall strategy for private equity is to make sure, as we look at strategies going forward, we have both the resources, whether it's internal or external, and the capabilities for appropriate underwriting for the types of risks that we're taking. And that's the approach that we're trying to lay out in the private equity strategy. And at the heart of it is what you've underscored, which is to be very clear where and when are there resources that we have internal to do this type of underwriting, and when and where do we need to partner with external resources, and what's the plan over time. And I think you'll be pleased to see within the timeline that that's one of the checklist items to make sure we have workforce planning to think through that. But I just wanted to underscore, this is a domain of quite a bit of risk, active risk to the program, and huge variability between managers, and huge variability between each individual company. And that's the domain for private equity as a whole, not in terms of California versus New York, or underserved areas versus regular areas. And our approach is to try and consolidate all of that risk-taking into main drivers of programs and return, that we can really focus on the expertise to make sure we have it without losing track of the policy goals that we have.
Clint Stevens, the only thing I would add is it is a domain of enormous risk, but it's also a domain of enormous opportunity. We will be looking at Pillar 2 co-investments and continue some of the work we've done, but there are also opportunities in Pillar 1. I mean, just last week I was in New York talking to a manager that focuses on the Hispanic community that's had fabulous returns, and so again, enormous risk, but opportunities as well.
Okay, good. So that concludes this report. I'm going to take a 10-minute break now because the next item, when we are about halfway through it, will approach the two-hour threshold. So we'll take a 10-minute break. We'll reconvene at 11 o'clock, and then we'll start the next item, and that way we could have the continuity of continuing. Okay.